Welcome to episode 24 of the 5-Minute Investor Podcast, where Stockhouse columnists Jon Brown and me, Trevor Abes, each deliver a 2.5-minute stock profile related to recent news stories with investment implications. This week, we're delving into a pair of Canada and U.S.-listed cannabis stocks whose underlying companies make strong cases for thriving in the current market, including capitalizing on the U.S.'s potential reclassification of cannabis as a less dangerous drug. Jon, which name in the cannabis space is intriguing you at the moment?
Well, Trevor, the stock that I chose is a pretty popular one for our readers, and looking at just how this could be a historic shift in cannabis policy and how this could impact this company, because, like you said, it will formally recognize the medical benefits of cannabis and ease restrictions on research and offer some tax relief to cannabis businesses and will penalize them from deducting ordinary expenses. One company that's looking to benefit in these areas is Canopy Growth Corp. It trades in the Toronto Stock Exchange under the symbol WEED. That's weed. Also listed on the NASDAQ under CGC. Its Canadian market cap is just under $500 million. In the U.S., its market cap is $360 million as of this recording. Through its Canopy USA structure, the company holds stakes in several U.S. cannabis operators. That includes Acreage Holding, Wana Brands, and Jetty, as well as some others. This setup allows Canopy to maintain its compliance with federal law while positioning itself for future growth in the U.S. market state to state. Earlier this month, Canopy reported some financial momentum. Its Canadian adult use cannabis revenue rose 43% year over year in the first quarter of fiscal 2026, reaching 27 million Canadian dollars. Now, as the federal policy evolves, Canopy Growth wants to capitalize on the opportunities ahead. For investors, the potential rescheduling of cannabis could be a major catalyst, unlocking new value in one of the world's fastest growing industries. Now, as for stock performance, Canopy Growth seems to be on a summer run. Since June, it has traded between $1.50 to $2 a share. Its U.S. counterpart has been in the neighborhood of $1, $1.50 a share U.S. Both stocks have risen 10 to 12% since June, but they've also lost around 45% since the year began. But that's my take on Canopy Growth. Surely you've heard of them by now, but maybe there's more to look at, given what the future could hold in store for it. And they're not the only big player in Canada's cannabis industry. Trevor, who's the other one you got to tell us about?
Yeah, Jon. My stock for episode 24 is Aurora Cannabis, ticker ACB on the TSX, a global player in the medical and recreational markets in Canada, Europe, Australia, and New Zealand, as well as a controlling owner of Bevo Farms, North America's leading supplier of propagated agricultural plants. Aurora is the world's largest medical cannabis company in nationally legal markets, a leadership position that has helped to turn its finances around as of late, following up billions in losses with a resounding return to profitability, achieving profitability on an adjusted EBITDA basis for the first time in fiscal 2024 at 12.8 million Canadian, record revenue of 47.2 million from the medical cannabis segment in Q1 fiscal 2025, record quarterly adjusted EBITDA of 10.1 million in Q2, record net income of 31.2 million in Q3, and positive free cash flow of 9.9 million, as well as new records for adjusted EBITDA and global medical revenue in full year fiscal 2025. With growth across key metrics pushing forward in Q1 fiscal 2026 and management expecting positive free cash flow for the second straight year, Aurora's shift into profitability stands in stark contrast to its competitors' steep losses because of industry-wide headwinds, including uncontrolled growth, excess supply, and margin compression, granting it differentiated prospects when it comes to delivering shareholder value. A reasonable investor would expect to see Aurora's financial turnaround reflected in its stock price, but this has been far from the case, with shares giving back about 40% since March 2023, creating a margin of safety wide enough to merit your dive into due diligence to substantiate a potential value play. As always, you can find links to the articles from today's episode in the show notes, and you can find more investing insights on Stockhouse and the market online. The 5-Minute Investor is on Spotify, YouTube, iHeartRadio, Podbean, Stockhouse, or wherever finer podcasts are found. Thanks for listening, and we'll see you on Monday. This podcast has been prepared as part of a partnership with Canopy Growth Corp and Aurora Cannabis Inc. and is intended for informational purposes only. For full disclaimer information, please visit themarketonline.ca/disclaimer.